Welcome back to the Deep Dive. Today, we're taking a really close look at a financial giant, JPMorgan Chase & Co. Ticker's JPM, of course. And the situation's interesting. The stock's been doing well, incredibly well lately, strong performance. But when you dig into the valuation figures our sources provide, it gets complicated, actually quite contradictory. We need to sort of unpack that for you. So JPM, most of you know, massive global financial services firm, four main parts: consumer and community banking, or CCB. Then there's the corporate investment bank, CIB. Commercial banking, BCAB, and asset and wealth management, AWM. Market cap right now, huge, around $848 billion. And the stock last closed at $308.37.
Okay, and right up front, we absolutely have to state the usual but very important caution. Everything we talk about today is just for information, for education. It is absolutely not financial advice, not intended to be. You really, truly must do your own homework, your own research before making any investment choices. Our goal here is simply to walk you through the data we've seen, the analyst takes, and, well, some of the conflicting views out there.
Right, so our mission today: pull out the key insights from JPM's Q3 2025 earnings, see what analysts are saying, and figure out what really matters for their competitive position. And critically, how should we think about this pretty significant valuation gap we're seeing in the source material? Okay, so let's dive into that recent scorecard. Q3 2025, it looked really robust, didn't it? Blew past what analysts were expecting. What were the big numbers that jumped out?
Yeah, the performance was stellar. Really showed the power of their scale. Net income hit $14.4 billion, diluted earnings per share $5.07, and revenue up 9% year over year, hitting $47.1 billion. But maybe the number that really tells a story for a bank like this is the return on tangible common equity, the ROTCE. It was incredibly strong, 20%.
20% ROTCE. Let's just pause on that. I mean, for anyone less familiar, that's a core measure of how efficiently they're using shareholder capital, right? Getting a 20% return on the tangible equity shareholders actually own. That's top-tier stuff, especially right now.
Exactly, top tier. And the interesting part, the revenue strength wasn't just, one thing. It was pretty broad, but definitely led by the corporate and investment bank. Their markets revenue jumped, get this, 25% year over year.
25%. Wow.
Yeah, huge jump. That strong trading environment, plus good contributions from investment banking fees, asset management, and their payments business too. That helped drive the beat.
And what about the consumer side, the CCB segment? The data seemed to suggest consumers are still hanging in there. We saw, I think, a 9% year-over-year increase in debit and credit card sales volumes.
That's right, 9% increase. It shows that core retail customers still spending, which is, crucial for their profits down the line.
So that kind of underlying strength, being able to earn money across different areas, that must be why analysts talk about their wide economic moat.
Absolutely. That's the core of it. What really underpins JPM's dominance? Well, first, it's their cost advantage. They just have this massive base of low-cost funding. They've been number one in U.S. retail deposit share for, 5 years running now?
5 years.
Think about all those checking and savings accounts. It gives them cheap, stable money that, frankly, few competitors can match. And when you combine that huge deposit base with their branch network and digital presence, it creates real switching costs for customers. People don't just easily leave. That protects their margins.
Yeah, that makes sense. But it sounds like they're not just sitting back either. They're innovating. I saw a note about the success of their Sapphire credit card portfolio. After they refreshed it, apparently it had its best year ever for new accounts.
That's a great example.
So actively defending that moat, right? Bringing in profitable customers with new products.
Exactly. They're reinforcing it. And when you connect that product success and their low-cost funding, well, it shows why they can be so strategic about deploying capital. Management sounds really confident about long-term deposit growth, and they're using that confidence to make some pretty big strategic bets. Like that announcement, the plan to provide an incremental $500 billion in lending over the next decade, focused on industries critical for U.S. security.
$500 billion. That's enormous.
It is, and they're backing it up with maybe up to $10 billion in direct equity investments in those same areas. This isn't just business as usual lending. It's, it feels like a strategic move to influence national economic direction.
That is fascinating.
Yeah.
But deploying that much capital, it brings up the expense side of things, doesn't it? They're investing a lot in tech, AI included. But management seems to frame it more as a way to get productivity gains, maybe slow down how fast expenses grow, rather than, immediate big cost cuts.
Right. It seems like a longer-term play. They view AI as an enhancer, something to make their people more productive, not necessarily replace them wholesale. I think they realize, especially in areas like investment banking, their real edge is still their human talent. So they're trying to find efficiencies to offset other cost pressures, like inflation, without gutting the core intelligence of the bank.
Okay, so despite this strategic vision and, frankly, the stellar Q3 numbers, we need to flip the ledger. Look at the risks. Let's talk about the bear case. What are the headwinds?
Well, the big cloud is macroeconomic uncertainty, and that means credit normalization is likely needed. Management was surprisingly blunt about this. They pointed to a specific issue, a $170 million charge-off tied to the bankruptcy of a subprime auto lender called Tricolor Holdings.
Right, I saw that. And they didn't mince words, did they?
No, they didn't. The quote that really jumped out was the warning, when you see one cockroach, there's probably more.
Wow, that's strong language from a CEO of a bank that size.
Very strong. They were basically saying, look, these non-bank financial institutions, NBFIs, they operate in riskier areas, maybe less regulated. They present these kind of unique credit risks. The tricolor charge-off was the cockroach. The worry is, if the economy tightens further, more of these NBFIs could stumble, and JPM's exposure could become a bigger problem, maybe even systemic.
So that $170 million isn't just a one-off loss in their view. It's a potential sign of wider stress in those less regulated parts of the financial system.
That seems to be the implication, a real insight into their thinking.
Okay. And besides that potential credit risk, what about internal costs?
Right. That ties back to the AI point. Even with tech investment, they're facing ongoing expense growth. They talked about a new normal for labor inflation, maybe running at 3–4% persistently.
Oof.
Yeah. And add rising medical costs, they projected maybe a 10% increase there. Put it together, and it's a significant drag. These aren't temporary issues. They feel like structural pressures. And it suggests that looking ahead to maybe 2026, their expense numbers could end up higher than what the market currently expects.
Okay, so we've got this picture, a market leader, operating really well recently, but facing these worries about systemic credit risks and stubborn internal costs.
Which brings us right to the big puzzle, the valuation. The stock's at $308.37. Our source material mentions a fair value estimate around, what, $291.55?
Roughly, yes.
So even that suggests it's trading a little bit rich already. But then it gets even more confusing when you look at the more cautious analysts. Exactly. There's a price target included in our source data that's way lower, significantly lower. It suggests a long-term target of $228.17.
228.17. That's a massive gap. Over $80 difference from the current price. How can views be that divergent on such a well-known, well-covered company?
It's pretty stark, isn't it?
Especially when, as you said, their wide moat is strong and their guidance on net interest income, NII, a key profit driver, seems strong too. They're projecting $95 billion for 2026, excluding the markets business.
Right. $95 billion NII guidance is very strong.
So why on earth would anyone have a $228 target? What's baked into that super conscious view?
Well, that lower target, the $228, it likely reflects a few major concerns that perhaps the broader market is downplaying. First, that systemic credit risk we talked about, the cockroach scenario. That target probably assumes a higher chance that plays out, requiring much bigger loan loss provisions down the road.
Okay, so higher credit costs assumed.
Second, the expense pressure. The $228 view likely assumes that 3–4% labor inflation really bites into margins, maybe faster than AI gains can offset it. And third, maybe regulatory capital usage. That huge $500 billion lending commitment, while strategic, ties up a lot of capital. Shareholders might prefer seeing that returned via buybacks. So it could create a kind of valuation ceiling. Essentially, it's a target built more around risk aversion than just NII optimism.
That really crystallizes the tension. You have the JPM, the clear leader, showing great recent results, strong forward guidance on NII. But it's balanced against these persistent, maybe structural expense issues and that lurking fear of credit problems spreading from the non-bank sector.
Yeah, that's the core conflict. Operational excellence versus valuation risk. But maybe let's leave listeners with one final thought, something bigger than just the next quarter's earnings. Think about the long-term impact of that huge capital deployment strategy JPM announced, that $10 billion in equity, the $500 billion in lending, all aimed at critical U.S. security industries. How might that level of focused strategic capital actually shape national economic priorities? How could it change the competitive landscape in those key industries over the next 10 years? That's a level of influence very few companies have.
That is a powerful question to think about. A lot to mull over there. Well, thank you for joining us for this deep dive into JPMorgan Chase. If you found this analysis useful, if it helped you cut through some of the noise, please do follow the channel and definitely subscribe and hit that bell icon. It really helps support our work and make sure you don't miss our next deep dive. We'll catch you on the next one.